What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. My guest in this week's episode is Sebastian Mallaby. Longtime listeners will remember Sebastian. He was one of our very first guests. He came on the show back in the early summer of 2017 to talk about his last book, which was a phenomenal biography of the former Federal Reserve Chairman, Alan Greenspan. And he's back on the podcast today to talk about his most recently published book on the history of venture capital. And man, did he crush it. It's an incredible history of a relatively misunderstood industry, and this was an incredibly enlightening conversation to have, not only because it gave me a much deeper appreciation for the evolution of venture capital, but also because it highlighted for me what makes venture capital so different from other forms of investing. My objective in bringing you this conversation today is to provide you with a framework for thinking about how to invest in businesses, initiatives, and projects which not only lack cash flows, but whose values are often fundamentally intangible, difficult to measure, and often impossible to quantify. As more and more of our economic life happens in the digital realm, the ability to assess value and invest accordingly will become an increasingly invaluable skill set for investors. In part 2 of our conversation, which is available to premium subscribers only, Sebastian and I delve into the geopolitics of venture capital. As many of you will know, I've done several episodes on this subject, most notably with former staff director of the Senate Armed Services Committee, Chris Brose. But today's conversation focuses less on specific technologies and more on the general state of play in the industry and how national governments can support their domestic defense sectors without creating the malincentives that we often associate with 9-figure fighter jets and $400 hammers. We also discuss Web3 in the context of initial coin offerings and how these types of crowdsourced investments have transformed the early stage landscape and brought public capital into areas of the market that would never have been able to source it only 10 years ago. Whether or not this is a good thing overall and what it means for innovation in the ecosystem for decentralized software is something else we discuss. Lastly, I had a chance to ask Sebastian about the uniquely challenging situation in which the Fed currently finds itself, and what he thinks is most important to focus on when trying to project the likely path for interest rates, economic growth, and asset prices. As always, those subscribed to our Super Nerd tier will also have access to the transcript to this episode, as well as the Intelligence Report, which is the Cliff Notes to the Hidden Forces podcast, formatted for easy reading of episode highlights with answers to key questions, quotes from reference material, and links to all relevant information, books, articles, etc., used by me to prepare for this conversation. And with all of that out of the way, please enjoy this wide-ranging and deeply enlightening conversation with my guest, Sebastian Mallaby. Sebastian Mallaby, welcome to Hidden Forces.
Yeah, great to be with you.
It's great having you back on the podcast, Sebastian. So you have written 5 books. 2 of the previous books were more biographical, whereas this book, along with More Money Than God, focuses more on the specific industry that they cover, that one having been the hedge fund industry, this one being the venture capital industry. What inspired you to write a book about the venture industry, and how did you sort of bob and weave your way from hedge funds to central banking and policy to now the vanguard of risk and innovation?
Well, I guess my previous 3 books before this one, The Power Law, were different slices of financial history, going from around 1960 to the present day. So hedge funds, More Money Than God, a history of public investing and sort of the efficient market hypothesis and the gaps in it. Then a book about central banking in the form of a biography of Alan Greenspan. Obviously, his career spanned from the 60s to the financial crash. And then just before that, there was also a book about development economics told through the story of the World Bank. And I wanted to do another financial history that would be kind of in my sweet spot. And as I looked around, it seemed like the most exciting frontier was technology investing, partly because there's an intellectual mystery at the heart of it, how do you even allocate capital when you don't have any financial quantitative metrics around what you're buying? So the basics that you would learn in business school of discounting the cash flow, the future cash flow on an asset, don't apply when you're investing in a startup with no earnings. So there's a sort of, all investment is about the future and uncertainty and making tricky bets on an uncertain future. But this technology startup stuff is really the distillation of that. It's like the extreme of that. And then the other thing is that venture capital, in terms of creating companies that change how we live, is obviously super important. Relatively small amount of capital goes into venture capital funds, but the consequences of what comes out in terms of companies like Apple or Google or Facebook is just enormous.
So you were kind of drawn to write about this because it was directly relevant to your life, understanding how these technologies got funded that have impacted how we live. And also, it sounds like you were interested in understanding how do you go about investing in something where you don't really have quantitative metrics for understanding it, when it's one of the fewer areas today where you have to rely on the types of intuitions and gut feelings and also, I guess, inefficient analysis that used to be more normal.
Right. That's well said. It's something which artificial intelligence is unlikely to disrupt.
So what were the big questions that you started off wanting to answer? Like, were there certain things that you wanted to uncover, prove, or disprove when you began your research on this story?
Yeah, right at the beginning, I almost didn't write the book because it seemed as though you could explain the entirety of venture capital based on a theory of luck plus path dependency. What I mean is that if you look at a venture capital portfolio, there are 10 bets maybe, and probably 8 or 7 went to zero. The company failed, the startup failed. And then there are 1 or 2 that do great. And that has a slightly Las Vegas feeling to it. And then when you put on top of that the fact that once you do well in venture capital, the best entrepreneurs will come to you and you'll get better deal flow. And you'll probably be able to pay a bit less to get into that deal because your reputation is going to be helpful to the startup. And then you can sell it for more when you raise the next round because other investors are keen to follow your investment if you are a prestigious VC partnership. So all of these things together means that once you could be lucky at the start, and then path dependency could just keep you going and keep you in the top tier. And unless I could think of a good reason why that wasn't true, there didn't seem much point in writing a book about the skill in venture capital or trying to find it if there wasn't any. But then as I asked more questions and got a bit closer to the subject, I began to understand that there was skill. And that was one of the sort of surprises that then hooked me on the subject.
Yeah, another question I have related to that is, okay, if we assume that it's not all luck and there is some amount of skill, how much of that skill is identifying winners? And how much of that skill is actually everything you do to complement those, quote, winners after you've picked them, ways in which you can add value to the venture? How do you think about that? And how does that break down in the Valley? Because one of the things that you did in the book, which I love, is you describe the historical evolution of the industry and how it went from being much more hands-on in the earlier days to later going through a period like we've been through recently where the view was kind of just give the founders what they need. And you also have angel capital, which is less hands-on by nature. So how do you think about that dichotomy?
Well, venture capitalists of the sort of traditional Series A sort who take a company after the angel has done a first investment and then really get it to the point where it's got its first customers, the product is fitting the market. They are very hands-on. And I think that's super important for the development and success of startups. And part of being hands-on is hiring the first 5 engineers or the first 5 marketing people, alongside the CEO. Obviously, it's not the VCs doing it by themselves, but they are actively interviewing people and sourcing people from their network. And I think that's really important to company building. It's not clear that that's really, though, what differentiates one venture capitalist from another, because I think they all do this. Some will do it a bit better than others. But I think if you try to explain the big difference in returns, that's probably more in like the deal sourcing. It's, did you back the team that turned out to have the product that just took off? And so, when you look at the really successful companies, whether it's Facebook or Google or some others like Stripe, probably the founders were just super competent, super driven, and they had an idea for the business which was really going to fit the market. And the VCs helped at the margin, but they didn't explain. What they did after the deal is not the main explanatory factor. So I think probably deal selection is more important than deal custodianship.
That's interesting. So that actually raises a couple questions. First of all, it brings us back to the original observation, which is this is an area in investing where there still is a lot of qualitative analysis. But within that qualitative analysis, you as an outsider came in trying to identify some type of formula for success. What were you able to derive from your experience from all the interviews you did? I mean, were there certain types of things that time and again proved to be correlated with success in early stage investing?
Yes. So right at the beginning, there were a few mental models that had to be adopted. One was this power law idea, which is that it's okay if 8 out of 10 bets fail, because venture capital is a game about backing investments in the tail, the ones that are exceptional. And so it's all about getting those exceptional companies that break out. And to get an exceptional company, you do have to take risk and bet slightly you bet on contrarian, crazy ideas slightly. So some of those crazy ideas will turn out to be just plain crazy, not crazy brilliant. So I think the first thing is to accept that, to understand that risk management in venture capital is about embracing more risk.
To be willing to lean into risk.
Yes, exactly. And that was something which was talked about by the first West Coast venture capitalist, Arthur Rock. He didn't call it the power law. That was a term that came up much later with Peter Thiel. But he expressed the concept, and he was talking about the same thing. So that's the first thing. Second thing is you've got to be willing to use only equity. In the early days, some people use debt, which is ridiculous for a growth startup because a growth startup needs to take in capital to grow. It doesn't want to pay back debt service payments,
or if you
payments.
were Fairchild, you had the option to buy the entire company.
Right. That was also a bad opening structure. So there were some of these basic things. Another one is stage-by-stage financing, that you give a risky startup a bit of money to try to take away the worst risks. And then only if it succeeds do you give it a bit more money to tackle the next risks. And that way, if it fails, it'll probably fail cheaply, which is a good risk mitigation strategy. So these are the original kind of building blocks. And then I think when you look today at what differentiates the really good venture partnerships, I would say a few things. One is you have to be deliberate and strategic about how you nurture your network so that good entrepreneurs will pop up on your radar really early on. So an example of this is that Sequoia Capital, probably the top venture capital company in the Valley, has a thing called the Scouts program. And when it initiated this 10, 15 years ago, it was pretty new as a concept. And the idea was you give your existing portfolio founders, your company founders, $100,000, $200,000, and say, you go make a few bets on people in your network who are emerging company founders who you think are really smart. And then if the bets go well, you get to keep half of the upside from this money that we're giving to you. But of course, for Sequoia, that meant that the smart people in the network of the current smart founders would be on their radar screen from very early on. So that's a sort of network building strategy. So that's number one. Number two is you build decision science into your decision process. So we know from decision science, these are experiments going back to the 70s, famous things by Tversky and Kahneman at the foundation of behavioral economics, that people are risk averse. So they are willing to gamble to avoid a loss, but they don't necessarily gamble or embrace risk when they're going for the upside. And since venture capital is all about the upside of a few outlier companies, you've got to kind of rewire your brain to do that. And so what Sequoia did was that they said, when you write a decision memo before an investment, you have to include a section that would imagine and dream how great this company could become if everything went right? Stop worrying about the risk. Just tell us, what if everything went right? It's called the pre-parade section of the memo. And that liberates the investor, gives the investor permission to really express all the excitement and enthusiasm, which normally, we're human beings. We don't want to say how excited we are, because if it goes wrong, we'll be embarrassed, we'll look stupid. And as one Sequoia partner said to me, venture capital is about being embarrassed. That's our job. We have to be embarrassed. And to get our heads into a place where we can do that, we invented this mechanism. Anchoring is another behavioral bias that is famous in the decision science literature. And that means, you make a decision, you take a point of view, and then you don't want to change your point of view because you're kind of anchored on it. Or maybe your colleagues or your friends, people you respect, have taken a point of view, and you kind of set your position relative to theirs as opposed to having a fresh, clean position all of your own. And these kinds of anchoring are an obstacle to objective thinking. And so again, Sequoia invented mechanisms to avoid that sort of anchoring when they came to deciding on startup bets. So those are some things. I just add one more category of smart procedure that a good venture capitalist makes. And that is, you've got to focus not just on being a bunch of individual investors who go out and find deals and who are smart about that. You've got to think about the glue and the culture within the partnership. So you've got to think, for example, about developing the younger partners so that you have a farm team who can take over the leadership 5 or 10 years later. That means when a young investor brings in a deal, you might say to that young investor, okay, great. Now we'll pair you with a senior investor who will go on the board initially, and you will be the shadow. And then if the company goes well after 3 or 4 years, you will take the leadership position and be on the board. And that has two benefits. First of all, you'll learn how to do it. And secondly, only if the company goes well will your reputation be associated with this startup. And so it'll be like a halo effect for you when it has an IPO. And that will build your reputation and your ability to be sourcing great deals in the future. Whereas if it fails after 1 year, the black mark won't be on your reputation because you were not the board member at the beginning.
Yeah, amazing. I think to see if I can summarize what I'm hearing here, as opposed to, let's say, the traditional large institutional investors who try to create protocols or a formulaic approach around metrics of success, trying to calculate the metric of success or identify metrics of success and invest accordingly. In the venture industry, it's more about trying to set up the conditions for success. Would you say that's accurate?
That's extremely well put, because fundamentally, there's no algorithm to discover disruptive startups, because by definition, they're disruptive. So the past data won't capture what it is that they're doing. So it is a sort of game of intuition that you meet with startup founders and you're making a judgment partly as to whether their vision of the product they're going to build, whether that would work. Secondly, if it did work, how big would it be? Because you only want to take these risky bets if the upside is huge. And thirdly, are these the right people? Is this the right team to actually execute on this? These are all very human judgments. You need emotional intelligence as well as just straight IQ. And therefore, it's about supporting the individual investors and getting their heads in the right space to be able to make those very difficult judgments.
One of the other things that you mentioned is the need to lean into risk and to reformat your brain from thinking about all the bad things that could happen and all the ways in which you need to kind of de-risk this investment, which is an important part of the process, clearly, to thinking about, well, if everything goes right, how big will this be? And that's also just so sexy and exciting. One of the things that's so exciting about venture capital is that you do get to dream big. This makes me think about the culture of venture capital and the culture of Silicon Valley. And it strikes right at the heart of a number of questions that I have in my head, which is why, and maybe this the biggest one, and one that you sort of grappled with in the book, which is why Silicon Valley? Why Palo Alto? Why the West Coast of California? Why did this particular culture and this industry grow up in that part of the United States? What did you discover when you began down this road, and what was the conventional thinking around why this was the case?
So the conventional thinking about why Silicon Valley included a bunch of hypotheses that people threw at me when I was beginning. One of them is that Stanford University is so fantastic and sort of has this culture where you can take a sabbatical and go do a startup and then come back and all of that. And so really it's Stanford Valley, not Silicon Valley. As I looked into this, it seemed implausible that that was really the real answer, because in the beginning, when Silicon Valley went from being kind of equal with Boston to being over, in front of Boston, which was kind of the 1980s, where it overtook Boston, MIT was a stronger engineering school than Silicon Valley was. And Harvard was a stronger academic center than Berkeley. So it's not about the best university. Carnegie Mellon is a fantastic engineering university, and yet Pittsburgh was never an entrepreneurship center.
Also, wasn't most of the technical innovation happening on the East Coast during World War II? I mean, Vannevar Bush was out at MIT.
Yes, exactly. Which points to another theory, which is like it's all about defense dollars flowing into the valley. People would say that too. Now, it's true that some defense dollars did, defense contracts, but more went to MIT Boston for the reason you just stated. I mean, Vannevar Bush was dean of the engineering school at MIT, but also FDR's science advisor during the war. And, George Dorio was the sort of tech procurement person for the military during World War II, and then headed up American Research and Development, which is kind of a proto-venture capital company, started in 1946, and it did pretty well for a while. But the Valley still overtook these characters. Why did it do that? It wasn't about defense dollars, as I said. It's not about Stanford. So what was it? So another theory is, well, there's something about the West Coast ever since 1849 and the gold rush. People with entrepreneurial, risk-taking genes moved west, and that kind of carries over to this day. This struck me as sort of pretty unlikely, because so many people in the Valley are actually not born there. They're immigrants to the Valley. So the notion of some sort of continuous gene pool is not plausible. And the idea that you kind of sniff the air when you get out to the West and that changes your risk appetite seemed a bit vague. So as I looked at it, I realized that a lot of the things that people ascribe to something in the water that you drink or something in the culture, those things actually come from venture capital. So the willingness to start a company and take a risk is there because venture capitalists are running all over Silicon Valley, encouraging people who have a job at Google or in the old days at Hewlett-Packard to leave that company and start a new one. They'll say, look, you've got a good idea. Your boss doesn't want to implement on it. Why just hang around and let that good idea go to waste? Start your own company. And the person at Hewlett-Packard says, yeah, but it's risky. And the venture capitalist says, well, I'll raise the money, so you're taking a risk with somebody else's cash. Then the Hewlett-Packard person says, yeah, but I can't do this by myself. I need to hire 5 engineers to help me. No problem, says the VC. I'll go find the 5 engineers. Then the VC goes to see those engineers, and those people say, yeah, but I have a nice job. I'm working at Intel. Why would I leave? And if I do leave, the startup might fail. And the venture capitalist says, yeah, you're right. The startup might fail, but don't worry. I fund multiple startups every year. And if this one fails, I'll get you a great job at another startup. And so venture capitalists are out there turning people into entrepreneurs, turning people into, ones who are willing to join startups. It's a machine for manufacturing courage.
Interesting. Manufacturing courage. I've never heard that before. How interesting. You said a number of interesting things there that I hadn't heard, or something that you made me think of also, which is that in some ways, the VCs are not just de-risking investments for themselves, but they're de-risking the entire venture for the entrepreneur. Because the venture comes with a certain amount of risk at the very outset. So much risk that a lot of entrepreneurs are unwilling to do it, irrespective of whether they can raise the capital or not. So let me ask you this. You have a great name for this in the book. You call it liberation capital. What is the starting point for this that you've identified in your research? Like, where do you start the clock on when this culture of innovation mixed with intellectual curiosity, mixed with profit seeking, mixed with the quintessential Apple logo, think different? When did all of this come together as an origin point in your view?
The origin story I choose is the founding of Fairchild Semiconductor in 1957. This is the famous story where there are 8 scientists at Shockley Semiconductor, Shockley being one of the inventors of the transistor who got a Nobel Prize, but was a terrible guy to work for. And 8 of the young scientists who were brilliant working for him wanted to leave because he was such a difficult guy to work for. And their idea was that they would quit as a team and work for somebody else because they didn't have the idea of starting their own company. That wasn't something you did in the 1950s. It was the era of big business, not small startups. And they were looking for another company that would hire them, and they wrote a letter to a brokerage in New York called Hayden Stone, and the letter landed on the desk of a guy called Arthur Rock, and he flew out to the West Coast and said to these scientists, listen, don't just join somebody else, start your own company. Then you can own a chunk of the equity and be rewarded for that.
Let me ask you about that real quick, interjection. Where did Arthur Rock get that idea from?
That's a great question. And I think the answer just sort of had to do with his own personality, his status as an outsider. He was a kid who grew up in a tough neighborhood in, I think it was in New York State. I'm going to say Yonkers. I might actually have that wrong, but I should remember that. But he grew up in a small town in New York State. And he worked in his dad's grocery store, after school. He was Jewish, and there was a lot of anti-Semitic feeling in his school. He got beaten up the whole time. At one point, his parents wanted to bring suit against the bullies because he'd been so badly smashed up. He got childhood polio, and so he suffered from that as well. And he went to the military, as you had to in those days, for national service, and hated it and was being given orders by people he didn't respect because they weren't that smart. And he kind of got his revenge by being very smart, going to Harvard Business School, becoming a successful broker, but never really being part of the New York establishment because of his roots. And so I think he himself wanted to leave the establishment and be a loner, doing his own thing. And indeed, he quit Hayden Stone soon after that 1957 Traitorous Eight deal. And so it came naturally to him to advise them, you should quit and start your own company because, you know what, there's justice in the idea that smart people who create something get to own the fruits of their work.
So how, something else that comes up in that example when you were describing Arthur Rock is something that I've heard Josh Wolf say often. He's been on this podcast and you interviewed Josh for the book, which in the second part of our conversation in the premium feed, we might have a chance to discuss that. But one of the things that Josh often says is chips on shoulders. He's long chips on shoulders. He's long people who have something to prove. Also, the outsider phenomenon, this is a common thing. Jews, immigrants, people that came from outside of the culture seem to, in many ways, either, again, had something to prove, but also maybe came with a different perspective. Did you find that also to be true in your research, that a lot of the people that tended to succeed in venture capital, both on the investment side and on the founder side, tended to be either immigrants or people that were somehow different, fundamentally different, so much so that they had a different perspective on whatever it was that they were dealing with?
Yeah, totally. I mean, there's a really outsized number of immigrants amongst successful startup founders in Silicon Valley. If you look at the top venture capital partnership, Sequoia, the leaders of, the most recent sort of 10, 15 years in the US include an immigrant from Italy, an immigrant from South Africa, and an immigrant from Britain. It's very much an outsider-driven mentality that you're kind of not joining a big company and working your way up, partly because you don't fit into that, right? As Peter Thiel writes in his book about startup culture, when he began PayPal with 6 co-founders, I think 4 of them had tried to build bombs in high school. So this is a kind of culture of misfits and contrarians.
I actually just finished recording an episode with Jimmy Soni. I read his book, Founders, on the history of the PayPal Mafia. So I've been steeped in that history. I mean, it's an incredible story. And you write about it in the book as well. Particulars from the standpoint of Sequoia and Mike Moritz and the role that that firm played in helping PayPal navigate a really, I think, 3 to 4 very dangerous years. It was a company under siege. Again, something that's a common story. And again, we might have a chance to discuss PayPal. There's so many interesting cases in your book: Atari, Apple, Genentech. But let's go back to the traitorous sake, because it is such an important foundational story. And again, I want to emphasize it's right there in the name, the Traitorous Eight. They were traitorous to the culture of the time, to the way in which business was conducted. How big of a psychological break was that, do you think, for the people that were living through that experience? And then walk me through how that deal came together, how it resolved, and what ultimately the returns were. Because if I'm not mistaken, I think I remember the returns being like 600x, which is absolutely wild if that's true, if I got that number right. Do I have that number right?
Yeah, you're exactly right. It was 600x.
So, I mean, that's remarkable to me, and I'll tell you why. Because one of the questions I want to ask you is how the availability, the cheapening of capital, the greater availability of capital over the last several decades has influenced returns, because we've seen enormous returns that, I mean, the PayPal Mafia, I don't remember in this case what their returns were, but there were a lot of other companies I had studied from that period, from the 90s. And when you look at the returns that their founders generated, they pale in comparison to what people have been able to generate in the last 10 years. And crypto is the ultimate category that you didn't really write about in the book that I recall. And it's something I do want to ask you about. But so there's been this tidal wave of liquidity, which has in some ways amplified the power law, something we didn't define. I also want to define that. So in that way, the Traitorous Eight's returns of 600x stand out even more, because those are phenomenal returns. And in 1957 or 1960 or 60, whatever it was, whenever they actually cashed out, that must have been, I don't know, did you interview people? Who did you speak to kind of convey to you the emotional experience of actually creating that much money in such a short period of time?
I mean, so that part of the research was difficult because Arthur Rock is still around, but he's a sort of slightly shy, subdued nonagenarian, and he's not going to, gesticulate and say how excited he was. Maybe also because he had much more exciting bets later that we can come to in things like STS, which got sold to Xerox, the kind of WhatsApp of the 1960s, absolutely massive return. And others I spoke to amongst the Traitorous Eight were similarly old. And this is, so I couldn't really capture the emotional excitement of this, other than to say that clearly the numbers speak for themselves. And, particularly in the culture of the 50s, where you just didn't do that kind of thing of starting your own company, it was a bonanza. Did
you get to speak with Gordon Moore?
I did not, no. I spoke with Jay Last, who was one of the other traitors. I think he was the only one I reached who was still happy to talk.
I had watched an interview of Gordon Moore's that is available on the online library of the Computer History Museum. And he was so charming and funny, and it's just amazing to listen to that. And you had an opportunity to, whether interview those people individually, you also had a chance to go through all this library of knowledge. So in any case, that aside, I'd love for you just to kind of tie this off on how did this one success kind of come together? Because out of Fairchild Semiconductor emerged a lot of people who later seeded the rest of the valley. So it is a kind of foundational story.
Yeah, so just on the question of how they then founded Fairchild, just to close the loop on that, because it gets to this idea of liberation capital. What happened was that Arthur Rock comes out to the West Coast from New York and says, you should start your own company. And they literally say, what do you mean? How do we do that? And he goes through the thing. He'll raise money for them. And they say, yeah, but, we'll need a lot. And he said, well, I'll raise a lot. And then he kind of persuades them to go select somebody who will lead their group. Initially, when they wanted to just leave as a collective of scientists, they didn't need a potential CEO. But now that they were going to do their own company, they did. And Arthur Rock forced them to do that. So he really catalyzed the whole idea of creating Fairchild Semiconductor, which is an illustration of the way that it's venture capital that drives this risk-taking, this entrepreneurship. It's not, Gordon Moore, in one of those archived interviews that you're talking about, says, the accidental entrepreneur like me needs to be pushed into it. And it was Arthur Rock who pushed him. It's an amazing statement because Gordon Moore later went on, and this gets to your question about the legacy of Fairchild. He went on to found Intel with Bob Noyce in 1968. So he did two historic companies, Fairchild and Intel, and yet he calls himself an accidental entrepreneur, right? Which shows you how important the accident creator, namely the VC who pushes people to go and do the company, how important that really is. And then if you sort of go forward, at one point there was a calculation on the Computer History Museum website actually showing that 70% of the market cap in 2014 of all Silicon Valley companies originated from sort of the Fairchild lineage, that, some company had started another company like Intel, and then out of that had spun another company. And then if you trace the value of all those descendants in the family tree, you get to 70% of all the market cap created by Silicon Valley. So it was a huge thing, Fairchild, and it wouldn't have happened without Arthur Rock.
What other companies and investments stood out for you in your research?
Well, one could choose lots of them. I mean, in some ways, to jump forward, a fun story is Facebook, because it illustrated two or three things, right? So one is that when it wanted to raise Series A money, it was incredibly tough on the investors because it knew that it had a hot product and it would basically be able to take the pick of investors that it wanted. And it had a grudge against Sequoia because Sequoia had previously funded Sean Parker and then fired him from his companies. And Sean Parker was Mark Zuckerberg's sort of sidekick at the time. And so when it came time to present a business plan to Sequoia, Mark Zuckerberg shows up late. He's wearing pajamas. He does not pitch Facebook. He pitches some second-order side company. And then the slide deck that he presents says 10 reasons why you should not back me, including reason number 2, we showed up late wearing pajamas. So they were just mocking Sequoia. So that shows you how the balance of power had shifted between the capital providers and the capital users. Then another story, once Facebook was on its path to success, and we're now in early 2009, and the company is worth about $10 billion. Because of the '08 crisis, all of a sudden it becomes very difficult to raise capital. The usual suspects are not willing to write big checks. And Mark Zuckerberg sends his chief financial officer off to the Gulf to talk to the Gulf states to try to raise money, and even they say no. So now they're looking a bit, desperate, and they get a call from a Russian in Moscow who says, I've heard on the grapevine that you need capital, and I would like to invest. And the chief financial officer of Facebook says, wait, who are you? Have you ever been to Silicon Valley? And he says, my name is Yuri Milner, and I've never been to Silicon Valley. And the chief financial officer of Facebook says, well, look, you've never been to the Valley. You're wasting my time. This isn't serious. Have a nice day. So Yuri Milner puts the phone down and then flies to Silicon Valley and makes another call from San Francisco Airport and says, okay, now I'm in the Valley. Now will you see me? And at this point, through a mixture of, being impressed, feeling slightly sorry for the guy, the Facebook CFO takes the meeting, and Yuri Milner turns out to be the founder of the Facebook clone in Russia called Mail.ru. And he's got a multi-country spreadsheet showing how social media companies like Facebook have monetized all over the world in like 30 different markets. And he's so knowledgeable and thoughtful about the business model that he talked his way into Mark Zuckerberg's office, and then he makes the investment. And that is basically the growth of a new style of investing in tech companies in the United States, namely growth investing, where you write very big checks to established unicorns, and you don't demand any governance rights. So Yuri Milner's attraction to Mark Zuckerberg was partly that he said, Mark, I defer to you. You're a founder. I'm not going to tell you what to do. I will invest. I won't ask for a board seat, unlike everybody else who wants to invest. I won't exercise government. I will actually trust you completely, so much so that not only will I not be on the board, I will vote all my shares with you every time. So from Mark Zuckerberg's point of view, if you're the founder, this is not sort of diluting your control, it's enhancing your control. That is super seductive to a founder. And so that way, Yuri Milner talked his way into the deal, and it was a playbook that others then followed over and over and over, and growth capital became a huge force, creating all these unicorns all around the tech ecosystem. And in my view, kind of overshooting and leading to things like WeWork and Uber, where too much money went in with too little governance oversight.
What accounts for that growth in growth capital? And do you think on par it's been positive or negative? Because in some cases, we've seen the effects of that with, for example, Travis Kalanick and Uber, or Adam Neumann and WeWork. So where do you come down on that? And also, again, what accounts for it? How much of it is because of the broader tidal waves of liquidity that have drowned markets across the world, not just in venture?
Look, I just told you a story about the birth of growth capital, and it was 2009. And we know that between 2009 and the beginning of this year, there's been a secular bull market in tech stocks. So clearly that has quite a lot to do with it, why it's grown quite so much. I also, though, think that there is a sort of logic to this kind of investing, which is seductive to the investors and then seductive also to the investees. And therefore, even if there's a shakeout this year in tech stocks, which I do expect, I believe this will continue. I don't think it's a good thing it will continue, but let me just explain. Basically, I've explained already why, from the company founder point of view, it's terrific to get this capital from growth investors who don't want any governance rights. It just enhances your control, and you don't have to go on the stock market. You don't have to do quarterly earnings calls with shareholders. You don't have to worry about hedge funds that might go short your stock. You don't have to worry about activist investors. You don't have to worry about M&A threats. It's just great to be freed of all that. So anytime there are growth investors offering this capital, it's going to be attractive to unicorn founders. Then if you ask the question, well, why do those investors offer such generous terms? I think even though the bull market has been crazy strong in tech stocks, you could imagine that it had been only half as strong, hadn't overshot, but was still creating a ton of value. And it would have been a sustainable thing that investors would want a piece of. I mean, basically, technology is rewriting the rules of capitalism. Tech companies are taking over our lives. It affects the way that we do everything. And the companies that know how to do this are going to be dominating the future economy. And so to own a piece of that is just super compelling for an investor. So I don't think that's going away. I wish there would be more governance. I'm not certain there will be.
So Sebastian, I'm going to move the second part of our conversation onto the premium feed. I want to continue this discussion that we're having now. I also want to ask you about I guess, how would I put it, the geopolitics of venture capital? Because again, I mentioned Josh Wolf, his firm is kind of very much involved in this type of stuff. We had Chris Brose on the podcast, who was I think his official title was Chief of Staff of the Senate Armed Services Committee. He's with Autoril now, which is Lucky Palmer's company. So there's a kind of a flourishing scene happening in venture around military, commercial use of military type technologies. You have the rise of China, and it's a very interesting field to look at. And also to ask, how do we support our domestic national innovation industry without, let's say, overly subsidizing or creating misincentives? I also absolutely want to ask you about crypto, because from my perspective, the ICO and the way in which capital is raised through crypto, which I think is a derivation of what had begun to happen previously with platforms like Indiegogo, and there was another platform, I can't remember which was the first one, Kickstarter. It's this new kind of thing where, in some sense, we're looking to exhaust all the possible pools of available capital, while at the same time take advantage of a risk-loving culture that's emerged over the last several years, perhaps in part because of the reduction of interest rates and the difficulty of achieving high returns without taking these giant power law bets. I also absolutely need to ask you, Sebastian, it's not related to venture capital, but you've come on the podcast during a time when the Federal Reserve and rate hikes and interest rates and inflation and financial instability are all kind of right up in front and center. So I want to ask you about that as well in the second part of our conversation. For anyone who is new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to the second part of today's conversation with Sebastian, as well as the episode transcripts and intelligence reports, head over to hiddenforces.io and check out our episode library, where you can also become a premium subscriber today. Sebastian, stick around. We're going to move the second part of our conversation into the subscriber overtime. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to full episodes, transcripts, and intelligence reports, which include additional notes, resources, links, and other material that will help you get the most out of each and every episode, check out our premium subscription, available through the Hidden Forces website at hiddenforces.io. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.